G'day everyone, welcome back to Pete's Investing. Today is June the 7th, 2023. This is the US Canadian dollar currency update. We just broke down from a bullish signal on our weekly chart, and we're currently in our bearish signal on our daily, and I'll go through each of these. So first off, on the weekly, the CCI moving averages and the moving averages of the price chart are not aligned, so it's giving us this neutral signal. It was previously, a couple of weeks ago, a bullish signal, but in the last week and a half it's actually dropped off that. So currently neutral, so avoid long or short trades. On the daily, it has broken down into a bearish signal, as you can see, with the moving averages of both those indicators aligning. It's currently in this little wedge, which we drew some time ago. It broke up above that wedge, but now it's falling back into that wedge, and it possibly may approach this lower diagonal line, which has been drawn again. If I zoom out, you can see there those levels. There's also this key support area, 13226, and that's something that we need to keep an eye on if it breaks below this diagonal line. And also just while I'm here, is Fibonacci. You notice here it bounced quite nicely twice off this 61%, and that's always a key area to look out for, is a 61% Fibonacci on any chart. On the hourly chart, if I zoom out, you can see there those same levels, and more closely there is this bullish divergence happening on the hourly chart versus a bearish divergence on the price chart. And our indicator down here is showing a neutral, so it's undecided in terms of which way to go, so avoid trades at the moment. But the way this will typically work out is this is probably expected to turn up possibly in the coming hours or even days, and we'll draw a channel up to that high there, the highest candle bar on that particular divergence range, and a potential initial target would be a Fibonacci range. We take the next range, so if it breaks above that, let's assuming this CCI continues moving up and the price starts moving to the upside as well, and it breaks above this upper trend line, then our initial target area will be the next level Fibonacci. So that'll probably be somewhere in the range of the 38% to the 50% Fibonacci. That'll be our initial target, which coincides with this diagonal descending line as well, possibly. And then if it breaks above that, above the 61%, that's probably, and if it breaks above that, that's probably where it's going to be a potential trend reversal in the short term at least. These divergences don't necessarily mean a trend reversal long term. It just could be a little retracement before further it declines. So that's why I don't trade these. I use them as a potential change of direction in the short term. So to understand how to trade, also before I leave that, there's also this back testing up here. I've got a short positioning back test as well as a long positioning back test in the red and blue respectively. You can see there as the price was accelerating, we had single trades entered, and as the price started moving to the downside, or actually as the price was accelerating there, it was averaging down on the short side. So it was averaging down. We don't use stop losses. So to understand how to use this and other trading strategies, reference the links in the description below. Subscribe to my Patreon page, where we also do weekly scans of stocks, currencies and commodities. Subscribe, like and share the channel. Thanks for watching, and see you in the next video.